Valuing a fixed income bond starts out as simple math. You forecast cash flows and apply a discount rate. But that math gets complicated quickly when discount rates become moving targets, embedded options alter your potential payoffs, and the threat of default looms over the entire calculation. We are going to run through a 4-part progressive knowledge check to test your mastery of these variables. Let's start with Challenge 1, testing your grasp of the term structure. Imagine a central bank raises short-term interest rates to fight rising inflation. This action narrows the spread between long and short-term rates. What is the specific name for this yield curve shift? Take a look at this chart showing a normal upward-sloping yield curve. When central banks intervene to combat inflation, the short-term rates on the left side of the curve shift upward. Because the spread between the long and short rates decreases, the curve flattens. This specific movement is called a bearish flattening. For the second part of your baseline test, let's look at spreads. Which specific spread isolates minimal credit risk and is used to measure the overall health of the banking system? This matrix breaks down 3 distinct spreads based on the risks they isolate. The Z-spread assumes zero interest rate volatility. The TED spread indicates perceived credit and liquidity risk in the broader economy, but it's the MRR-OIS spread that focuses strictly on the banking system, measuring the amount by which the MRR rate exceeds the overnight indexed swap rate, which carries only minimal credit risk. Recognizing these baseline curve shifts and specific spreads is a mandatory first step. You have to understand these foundational mechanics before you can accurately price complex bonds in real-world markets. Now for Challenge 2. We are shifting from macro-level theory to direct mathematical application. Your task is to value a 2-year, 7% annual pay bond with a $100 par value, and you have to do it using a binomial interest rate tree. This incomplete interest rate tree establishes our environment. We have a starting rate of 4.5749% today at node 0. Looking ahead to year 1, the model diverges into 2 possible forward rates, an upper path at 7.1826% and a lower path at 5.3210%. To find the bond's value today, we use backward induction. We start at the end of year 1 and discount the year 2 cash flows back 1 period. For the upper node, we take the $100 par value plus the $7 coupon and discount it using the 7.1826% rate located exactly at that specific node. That gives us a value of $99.0830. We repeat that exact same logic for the lower node. Discounting the year 2 payoffs at the lower 5.3210% rate gives us a value of $101.594. That completes the first backward step for our straight option-free bond. Working backward, node by node, guarantees that we are correctly pricing the time value of money under different rate paths. This gives us our baseline present value, assuming, of course, that the bond has no hidden structural conditions. That brings us to Challenge 3. We are using the exact same 7% bond, but now we're introducing an embedded option. It is callable in 1 year at $100. This introduces the call rule. If the computed value of the bond at any node exceeds the $100 call price, the issuer will call the bond, capping the investor's return. At our year 1 lower node, our computed value was $101.594. Because of the call rule, that value is struck down and replaced with a strict $100 cap. Now it's your turn. Using the $99.830 upper node value, the new capped $100 lower node value, and the node 0 rate of 4.5749%, calculate the final value of the bond today. Pause the video and run the math. By averaging the discounted values of the upper node and our newly capped lower node, we arrive at a final node 0 value of $102.238. The embedded call option mathematically dragged down the total present value of the bond compared to its option-free baseline. This leads directly into Challenge 4. The values in that tree were built on an assumed level of interest rate volatility. If an analyst erroneously assumes interest rate volatility is lower than it actually is, how does that miscalculation impact the option-adjusted spread, or OAS? A lower volatility assumption triggers a chain reaction. When assumed volatility drops, The calculated value of the call option drops with it. Because the investor is short that call option, a cheaper option artificially inflates the calculated value of the callable bond. To force that inflated, erroneous bond value back down to match the actual market price, the model must compensate by computing an option-adjusted spread that is too high. Embedded options force you to evaluate a bond on two fronts simultaneously. You are constantly weighing the hard cap on your upside returns against the invisible, shifting weight of market volatility. Welcome to Challenge 5. Pricing embedded options perfectly won't save your portfolio if the issuer goes bankrupt. Can you define the specific formula used to calculate a bond's expected loss? Expected loss equals the total exposure multiplied by the loss given default, multiplied by the probability of default. It's important to remember that the loss given default is simply 1 minus your percentage recovery rate. For our final question, which specific credit analysis model treats default as a randomly occurring exogenous event driven by macroeconomic variables, rather than relying on a company's balance sheet? Structural models assume we can predict default by looking at a company's balance sheet assets and liabilities. Reduced form models, on the other hand, treat default intensity as a random statistical probability that varies as external economic states change. They don't try to explain why default occurs, only when it statistically might. Fixed income valuation requires balancing all of these factors at once. It means anticipating shifting yield curves, navigating mathematical trapdoors of embedded options, and properly weighting systemic default probabilities. And congratulations on surviving the valuation gauntlet.